I looked back at last year's first half as compared to this year's first half of the of our real estate market down here in South Florida. So I looked at the Tri-County area. I looked at sales up to 538,000. Can you see my screen?
I can see it. Yeah.
Right. So I looked at sales from 100,000. I wanted to exclude everything that was distressed. Those abandoned homes. I wanted to exclude that. Anything that sold for under 100,000, I didn't include in our charts here, and I included up to a purchase price of 538,000. The reason I did that is because conventional mortgages have a loan limit in the Tri-County area of 510,000. Right. So in other words, once you go above a loan amount of 510,000, you venture into the jumbo programs, you venture into the high balance program and so forth, which is typically not your first time home buyer pool.
Correct.
Right. Those are third, fourth purchases that clients make. So I wanted to include the bulk of our client base, which is essentially first time and second time home buyers. So I capped the sales price at 538 with the reasoning behind the maximum conventional loan amount. So if we look at here on the left, we have January through June 2020, and then on the right, January through June 2019. And if you can see the first 3 months in comparison, the blue lines are your sales, and then the orange lines is your median price. So I kind of wanted to show that the sales volume, the total sales, and at the same time look at the median price of the homes. So if we look at 2020 compared to 2019, there's a steady, healthy incline of property values. You see here through June, it ends at 295 median home price compared to last year at 280 as 2019. That's about a 4% increase, 4.5, 4.4% increase in property values, which is phenomenal. It's a healthy increase in property values in South Florida, right? I also looked at the total sales. Now, May was a terrible month for us. You can see here total sales were 3,500 sales. And that stemmed from closing down, right? Mandatory closings. Mm-hmm. That stemmed from job losses, unemployment, the temporary layoffs, and all of that. What's very a good sign is that the following month in June, boom, huge increase, almost doubled.
So Mario, check this out.
Yeah.
So January, February, March, right?
Mm-hmm.
Work in March is from effort in January.
Yep.
And February, right? Mm-hmm. So our mortgage business is a chess game. You're 2 moves ahead. So if you look at January, you're gonna see the fruits of your labor in March. So we worked hard the first part of the year as a group. We saw the fruits of our labor in March. But again, in April, March we shut down. April we closed our residual work from February.
Mm-hmm.
Okay. So now when May came, right? Now we're closing our residual down. We have a lot of slow because we can't get in there.
Yeah.
But look what's happened. People were working while they were sick, man, because look at June, mm-hmm. right? Because June's our effort from April. So everybody was pushing the ball, right? And everybody said, hey, we're sick. We can't go out. We can't do anything. It's not true. They were working. If you look at 19, same flow, January, February, March, April, climb, May, right? June shows up, summertime, everybody takes a vacation, it gets slower. So you can see the status, right? You can see the move of kind of what's happening. The spread between May and June of 2020 is the largest gap of any of your production, right? When we go into July now, guys, I can see it already because I have my metrics from what we're doing now. When we go into July, these metrics, you're going to see that same exponent. I'm sorry, I didn't mean to go on the camera. You're going to see that. I'm pointing to my screen. You're going to see that same metric that's really gonna be an exponent. So I think that when you do this next quarter or whenever you do it mm-hmm. next, that this scale is going to be even more of an exponent. What I think is also going to happen in talking about property values and availability, people want to buy because money is so inexpensive. Right. People, their length of money goes much farther presently. So what's going to happen is as we're going to see a little bit of strife. Where I think we're going to see a little bit of strife in properties is in a couple spaces. I think we're going to see it in the jumbo market, which we're not talking about here. Okay. And I think we're going to see it a little bit in the investment property market. There's a lot of Airbnbs that are having a hard time right now. They're all by and large on forbearance, but once they come back on, those may potentially be sales. Okay. Because people may realize that managing those was a hard thing to do when I don't control it. When those sales come back on, again, money's going to be very cheap. I think that we're going to see some inventory increase, and I think that we're going to see even more production out of this, because this is all with everybody having their mortgage payments taken care of by the government, right? April, May, June, that's up. So the ones that don't want to extend August 1, their mortgages are due. When they start to make those payments, if that economy, or if that travel economy, which is still kind of stressed right now, if that doesn't come back, we're going to see a lot of sales availability. We're going to see a lot of people moving.
Yeah, and it's important that we look at actual data, and this is directly from our MLS down here in South Florida, because if you look at the media, what they talk about is on a national level. So the media may be talking about property values as a whole, but it may not affect us here direct in South Florida. So I focused. This is data just in our backyard, essentially. This is the Tri-County area, and it's important that we look at actual numbers. And
it's relevant to us, man.
And essentially, we leave it up to the consumer to form their own opinion. But I wanted to present these numbers in a very transparent. Hey, these are the sales. People are actually moving. The prices are, the common misconception out there is that prices have skyrocketed since last year, and the data shows they really haven't. It's a healthy increase of about 4.5% from last year. That's a healthy real estate market, right? So,
and Mario, to that point, man, pricing's better this year than it was last year. So that same 4.5% costs the same amount of money, if not less. Exactly. Because rates are so much better. So even though pricing goes up a little bit, or the values, the cost goes up a little bit, but we're fortunate enough that we're combating that with the ability for money to be inexpensive enough to keep payments down.
Right. So in the whole, in the grand scheme of things, demand is high. What does that tell us? That once we are fully operational, once the, South Florida reopens for business 100% again, and we put all of these people back into the workforce, what is that going to do to the real estate market? It's going to drive up the price, right? At the very least, it's going to continue to a healthy increase of about 4%, 4.5% moving forward. So, to those clients, to those people that think that the real estate market is going to, for some reason, just drop out of, it's just not, the numbers don't show that.
I don't see it.
If market is driven by supply and demand, supply right now is low. There's not a lot of supply out in the market. Demand is high. That there's only one direction that the value of those is going, and it's going up. So for clients that are waiting for a market crash to purchase, guys, I just don't see it. The numbers don't show that. So I wanted to show this just to, show everyone that people are still moving. People are still selling their homes. The median home price is not something that's out of control. And then here I wanted to show the total sales without capping a total sales price. So this chart shows just your absolute total sales in the Tri-County area from the first half of this year compared to the first half of last year. So we were talking off camera a little bit right before we got on, and you mentioned that the previous chart essentially makes up about 80% of all sales that happen in the Tri-County area.
Yeah.
So that what goes back to tell you is that your first-time home buyers are still buying. Your second-time buyers are still buying, right? There's still some investors out there that are looking for good deals. So the market is moving. The market is not, there's no grim outlook as some people may be hoping for or waiting for.
Good. I found this really interesting, Mario, because I look at metrics, for our organization pretty regularly, but I never realized that inside the agency pocket that 80% of people live there. I'm thinking we do a lot of the non-QM stuff, which is also starting to come back. A lot of cool stuff going on there for investment properties to start buying up some of these B&B, Airbnbs or whatever, if you feel so inclined, right? But I found it very interesting that that much of the market, first-time home buyer, second-time home buyer, 15th-time home buyer, live in that pocket, man.
And guys,
the
he's
agency
referring
pocket, I thought
to
that was really interesting.
he's referring to the total sales here that we have 5,232 sales under the sales price of 538,000. So that makes up, it makes up the bulk of all sales that happen in the Tri-County area,
which is pretty interesting. I found that very interesting. I also find it very interesting that it's the same. It's really close to the same number spread, total sales versus agency sales. So the other parts of the market aren't really dragging that bad, man. So I think that's kind of cool too.
And Tim, man, our mortgage rates we're like in the 2%.
You're telling me, man. It's almost free money.
There's no reason to be waiting for a market crash to purchase something. I mean, when you look at, I talk to clients that think that there's going to be a market downturn in the future. And guys, at the end of it all, it's inevitable. At some point, there will be a market downturn. I mean, history just shows it would be, what's the word? Can't think of the right word, but non-realistic. I don't know if that's the right word or not. To assume that
naive.
It won't. There, thank you, Tim.
No
that it won't happen, right? Sometime in the future. But I just don't see it happening anytime now. And clients have been telling me there's a market downturn coming for the past 2 or 3 years, and the data just continues to go against that, right? So, and to those clients, I often ask, do you rather buy a $300,000 house at 2.5%, or do you rather buy that same house, at 275 for 3.5%?
It's the same cost of money.
And
it costs you the same money.
It's at the end of the day, there's a really low interest rates. You want to lock in your rates for the long term. Everything we do is fixed. None of our unless obviously there's exceptions to, but
I'm not seeing it, man. I'm not seeing anything in the ARM space that is, again, they've priced it out of the market because they don't know where it's going to go.
Exactly.
I've seen nothing in the ARM space, even in the jumbo market, which is coming back some.
We literally have 1 or 2 loans now that are adjustable rate mortgages, but it's a very specific case. It's very specific to that client, to that property. So it's not your norm. Essentially, all of our rates, most of our rates are fixed interest rates, 15, 20, 25 years, 30-year terms. And it just doesn't make sense for anyone that's paying high rent to wait for a market downturn when the rates are so phenomenal. Right. And I just wanted to show something real quick that I grabbed this from the Department of Labor. The economists were overall, they had forecasted about 3 million jobs to be added in June, and we added 4.8. And most of those jobs came from the leisure and hospitality sector, right? And about 2 months ago, I did this same slide, but it was how many job losses belong to which sector. And most of them were for leisure and hospitality, and most of them are back now. So we're seeing the market coming back. We're seeing, restaurants open. We're obviously, taking safety precautions and so forth, but reopening the economy is only going to strengthen the real estate market, which at the end of it all is one of the driving factors for the overall health of the U.S.
And on our side, Mario,